Zacks Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. This week's screen is one that deals with current ratio. I don't think I've ever heard of that before. I don't know if you have, but Kevin Matras, the head of our Research Wizard division and top stock screener here at Zacks, I'm sure has, because he's written about it in this week's piece, so he's going to fill us in all about this concept. We've never talked about this here, right, on Screen of the Week?
Yeah, you know, I think I have written about it.
Yes, we have, or no, we haven't?
I've written about it before, but I don't think you and I ever sat down and even discussed it.
All right, good, because I'm getting old.
Right.
And, you know, you just
never... You are getting old.
I am. And you just never know what you don't remember anymore.
Right. Well, the current ratio is simply another way to gauge a company's financial health. So, let's take a look at the definition first.
All right.
The current ratio is calculated by looking at the current assets divided by the current liabilities. So, the higher the ratio, the better, meaning the company has more liquid assets to meet its short-term obligations.
Okay.
Now, a ratio of 2 or more, for example, means a company has at least twice as many short-term assets than its short-term liabilities to be able to meet its financial obligations. So again, as a benchmark, if you will, a ratio of 2 is considered to be good. If you're below that number, people are probably going to look at that with, you know, kind of skewed.
All right.
So again, looking at 2, that's a good place to start.
All right. How is this applied? How can people use this?
Well, let me tell you how, but let me also, too, just mention that if you were to look at the current ratio for the stocks in the S&P at the moment, the current ratio is currently showing 1.75. This is a slight improvement from the current ratio from earlier this year when it came in at 1.67. But I also want to make note that the finance sector, which really has been beaten down quite a bit, the finance sector actually has seen its current ratio get weaker by a bit. The median current ratio for the finance sector right now is 0.99. This is a slight deterioration from the 1.06.
All right.
Now, the way that you're going to want to use the current ratio when you're screening for it, first, you're going to want to go look for the category that has ratios, because this is a ratio, right? And you're going to want to look in the liquidity and coverage section. Once you're in that section, you'll find an item that says current ratio. That's what we're looking at. And the way I like to use the current ratio is I like to compare it to the median for its industry. Because again, looking at it individually is one thing, but different industries will have different current ratios. So I think trying to find the strongest ones within its group is probably the best way to go.
All right, hit me with those parameters.
All right, here we go. Screen starts off by looking at companies with a Zacks rank of less than or equals to 2. So again, we're only putting strong buys and buys on our list. Then we get into the current ratio items. So we want to find companies with a current ratio greater than the median for its respective X industry. Once again, we're looking for companies with the strongest liquid positions to meet their short-term financial obligations.
Got it.
And then we want to make sure the current ratio is above 2 because, again, at the very least, we want companies to be able to be better than the commonly held definition of 2. Then we want to make sure that these companies not only have a good financial position, but we want to make sure that there's good growth rates looking out into the future. So we're looking for companies with a projected one-year growth rate greater than the median for its expanded industry. Once again, looking for companies better than their peers within their groups, right? And we also want to make sure that these growth rates are positive. It's one thing having a projected growth rate better than your peers, but if you're negative, I'm not interested. So they still have to have a positive growth rate, and I really do believe that it's important to look at this, especially as we enter into the Q2 earnings season. Now, all of these parameters are applied to companies that are trading over $5 and that trade at least 100,000 shares on a daily basis.
How many stocks came through this week?
There was quite a bit. I would say maybe over 50 or 60 stocks. So you're probably going to want to narrow this down a bit, maybe put in some additional price parameters. I would also suggest that you may want to really focus in on just those strongest industries. But here's 5 that caught my attention. C.H. Robinson Worldwide, Chatham Incorporated, HMS Holdings, S1 Corp, and Syntel. These are some pretty interesting picks, but they all have an excellent Zacks rank. They all have strong financial positions based on the current ratio. And again, they all are showing projected growth rates better than their industry and positive, which is very important.
Do you own any of these?
No, I don't.
All right. If you would like to check out those other stocks that have come through the screen this week that Kevin talked about, get on over to Zacks.com's homepage if you're not there already. Click on the headline right next to Kevin's name under the Screen of the Week banner, and his picture is right there as well, so it's pretty easy to come by, and it'll take you right to that information. And don't forget that Kevin also uses the powerful Research Wizard backtesting and screening tool to achieve all of these screens that he talks about with us here. And if you want to find out more about that, that information is available at Zacks.com/Research Wizard. With Kevin Matras and the Screen of the Week, I'm Terry Ruffalo.